Well, thank you very much for joining this morning as we review the highlights of the newest mortgage market data. As usual, our researchers will go over trends we think you should pay attention to in our 36-page chart book. We're also very, very fortunate to have Amy Cruz-Cutts joining our call this morning to offer her view of the data and the outlook going forward. Amy is a 25-year veteran of the mortgage industry, having served as the chief economist at Equifax for 8 years, and before that, as an economist for Freddie Mac, where she rose quickly to the position of deputy chief economist, serving in that role for 8 of her 13 years. She's also taught microeconomics at Georgetown, Johns Hopkins, and Syracuse universities. We'll start the call with 5 highlights from the chart book, including the impact of institutionalized forbearance and the new forbearance penalty on mortgage borrowers, the tightening of the credit box, the surge in refinancing and changes in profitability, the return of credit risk transfer, and the role of the Fed in the current crisis. Then we'll turn the discussion over to Amy to share her insights. Finally, we'll conclude with some time to answer your questions. If you have questions at any time, please either put them in the chat or email them to spardo@urban.org. Again, spardo@urban.org, or just add them to the chat at the bottom of the screen. So with that, Michael Neal will kick us off with forbearance, with the impact of forbearance and the forbearance penalty. Thank you, Michael.
Yeah, no, thanks a lot, Lori. Good morning, everyone. I'm glad you're here today. The coronavirus, has really kind of heightened the risk that mortgage homeowners would be unable to make their loan payments. In response to that, Congress passed legislation institutionalizing forbearance on a nationwide scale. And this is really the first time that such a step has ever been taken. So what are some of the effects of forbearance? I think on the one hand, forbearance itself has helped many homeowners remain in their homes, and the evidence suggests that many of these homeowners may be among the most vulnerable. But on the other hand, rules around forbearance have contributed to a tightening of the mortgage credit box. And so why are lending standards tightening? And this is taken from a brief that we did here in HFPC and released only a few weeks ago. There are a number of reasons lending standards are tightening, but a significant contributor to the shrinking of the credit box appears to be the new penalty imposed by FHA and the GSEs, both Fannie Mae and Freddie Mac, on lenders whose loans go into forbearance before they're delivered. In response, lenders have added additional filters to their underwriting process to weed out home buyers who might quickly go into forbearance on their new mortgages and trigger this penalty. Fannie and Freddie now place an additional delivery fee of 5% for first-time home buyers and 7% for all other purchase buyers and rate and term refis. Cash out refis that are in forbearance aren't saleable at all. Meanwhile, FHA requires the servicer to absorb 20% of the eventual loss if the loan misses 2 payments in the first 2 years. Some of the conversations that we've had with servicers indicate that the threat of this new penalty is contributing significantly to the recent tightening. These lenders know that they will pay this penalty on any loan that goes into forbearance before sale. So they're taking the action of filtering out the loans that could go into forbearance in part by reducing the time between loan closing and sale and imposing overlays on top of their traditional credit box. You can see here in this table that about 3% of the loans that were issued between December 2019 and June 2020 are in forbearance, and this is Fannie Mae specifically. And you can also see that the forbearance rate is considerably higher for higher coupon mortgages, which are riskier mortgages overall, but a bit lower for lower coupon mortgages, which have less risk. The loans made in May and June have lower forbearance rates than the overall rate, respectively. And these the most recent loans have lower forbearance rates in part because most borrowers would be in the same employment situation within a month of qualifying for the mortgage as they were when the mortgage was originated. In contrast, of course, longer loans have a higher probability, a higher likelihood that a borrower's employment circumstances will change. So what's the impact of all of this? We calculate that the gain to the government in terms of income is roughly about $53 million for about 3,750 early forbearing loans. But the cost, we think, is not worth the benefit. The cost is both a tightening of the mortgage credit box, which we estimate will limit access for about 255,000 borrowers. The main result then is that it's really not worth the additional income with the added cost that more than 200,000 borrowers will not be able to access credit either for a home purchase or to take advantage of historically low mortgage rates. Turning to the next slide, this is data looking at Ginnie Mae data. What we find is that forbearance itself has helped many homeowners remain in their homes. Again, particularly homeowners with the lowest FICO scores. This chart indicates, this chart indicates that overall about a third of mortgages have below a 660, while those across those loans that are in forbearance, nearly half, about 46% of those loans have a credit score below 460. Indicating that the lowest credit scores make up a disproportionately higher share of loans in a COVID-related forbearance. And you can turn to the next slide. Thanks, Kate. And when we take a deeper look at the credit scores or at the credit characteristics that are associated with loans that are in a COVID-related forbearance, and compare them with loans that are not in forbearance, again, within the Ginnie space, we see that not only do loans that are in a COVID-related forbearance typically have lower FICO scores, whether it's a purchase loan or a refi, but they also typically have higher debt-to-income ratios as well. Combined, this suggests that loans that are in a COVID-related forbearance do have somewhat weaker credit characteristics than loans that are not in forbearance. But again, at the same time, we also know that forbearance has helped many homeowners remain in their homes for the time being. The last point that I'll make is simply that the last 2 points I'll make is that loans that were in forbearance but were not that was not COVID related only account for about half a percentage point of all loans, and so we excluded that from our analysis. And then the final point that I want to make here is that I think it brings up the conclusion that in part it's important that the important benefit needs to be maintained. That is that forbearance helps homeowners remain in their homes. But at the same time, we need to find additional ways to keep the mortgage credit box from tightening, limiting the ability for people to either purchase a home or access low rates. Thanks a lot.
Thank you, JP.
Yeah, thanks, Michael. That was very interesting. I'll be talking about the credit box tightening that we see in our chart book. What we see generally is that FICO scores have been increasing considerably in the last 4 months, partly because of a surge in refinancing that's resulting from record low rates, which Lori will discuss next. But in general, FICO scores are higher for refinances. When we look at the graph on the left here, we see that non-banks in the GSE and Ginnie Mae space have significantly increased their credit scores from a year ago. It's about a 15-point increase for banks and a 34-point increase for non-banks since June of 2019. Since December of this year, we've seen that increase continue, 10 points for banks and 22 points for non-banks respectively. the surging non-bank FICO, the surging FICOs for non-banks is happening in part because of two reasons. One, that we see on the graph on the right is that there's been a compositional shift in non-bank lending. If you look at the top gray line, you see that non-bank lending in the Ginnie Mae space has been somewhat stable over the past year. While when we look at the yellow and black lines representing the non-bank share of Fannie and Freddie loans, those have both increased quite significantly. And as we know about Ginnie Mae lending is that the Ginnie Mae space tends to lend to borrowers with weaker credit profiles or lower FICOs. The second part that we see for the surge in non-bank FICOs is that, generally FICOs are trending up, and this goes back into what I mentioned at the start is that this is the result of massive refinance rates. In the GSE space, FICO scores for banks and non-banks have practically converged at 770 and 766 respectively. But in the Ginnie Mae space, we continue to see there's a 20 point differential between banks and non-bank FICOs. And implications of tightening credit is first-time home buyers. But what we've seen is that first-time home buyers have not been in the purchase loan space have not been deterred by rising FICOs. In our most recent data in the Chartbook, first-time home buyers make up 84% of new purchase originations of FHA loans, 55% of VA loans, and about half of GSE originations. And when we look at FICOs, what we know is that first-time home buyers tend to have lower FICOs than repeat buyers. And as we break this out over time for the past year, while FICOs for first-time home buyers have gone up slightly, they still remain quite below repeat buyers. And the rise has not been enough to deter first-time home buyers from maintaining a significant share of purchase originations. Some of the conversations we've had with folks on why first-time home buyers have remained so strong have pointed to things such as lower prices benefit first-time home buyers more, as well as there's less interference from COVID restrictions. You have one transaction for a first-time home buyer purchasing a home versus two transactions selling and purchasing a home for repeat buyers. And with that, I will pass it over to Lori.
Well, thank you very much, JP. And just FYI, that last slide was in response to a question that we'd gotten about first-time home buyers and what's happening with their FICO scores. I'm going to talk about the surge in refinancing and changes in originator profitability. If you look at this slide, what you see is that origination volumes in 2020 are actually the highest they've been, are expected to be the highest they've been since 2003. And I think this is really interesting. There's if you look at the average of the MBA, Fannie, and Freddie estimates for this year, total originations are expected to be about 2.9, are expected to be 2.9 trillion. Again, the highest it's been since 2003. You can see that the, last year was robust. 2012 was robust, but again, we're much, much higher this year because of extremely heavy refinancing volume because of rates at generational lows. And you see the very high refi volume in the next slide. This just shows you the refi share, and you can also see that mortgage rates are as low as they've ever been. We've never been as low as 3% on a consistent basis before. So interest rates at lows, the refinancing share as high as it's ever been. Somebody had asked what happens to, could you turn back one slide, one more second, JP? Someone had asked, or Kate, someone had asked what happens to volumes next year, what's expected. Next year will most likely be lower because this volume of refinancings will probably not be sustained. So origination volume next year is projected to be in the range of around 2.1 to 2.3 trillion, down from 2.9 trillion this year. Skip ahead 2 slides. Next slide. Um, one of the consequences of the very high refinancing volume is that primary spreads are very high relative to the 10-year note. So even though rates are low, they theoretically should be even lower. This shows you the average spread between the primary mortgage rate, that is the PMMS rate, the Freddie Mac survey rate, and the 10-year Treasury note has historically been about 174 basis points since 2004. Now it's 242 basis points. Yes, that's down a fair amount from almost 270 basis points in April, but it's still higher than it should be. That is, mortgage rates are low, but they should be even lower. However, there is no incentive. However, originators have no incentive to reduce rates right now when they've got a line of refinances out the door. And you can see this very clearly in the next slide, which shows that originator profitability is very near an all-time high. This actually shows you the spread between, this covers originator profitability. It doesn't fully measure cost, so it's really originator profitability and unmeasured cost. You can see it's about 5 points, down from about 555 last month, but again, higher than it's been at any point except for very briefly in 2012. That is, given the huge volume of refis, rates are higher than they should be, and that's resulting in greater originator profitability. Now, we would expect over time that as the refis are processed, rates would begin to come down if Treasury rates stay here, but it's going to be a slow process. Next slide. So the refi wave has had some pretty big implications for market shares in terms of within the agency market. You can see that the Ginnie share of monthly gross issuance had been sort of running in the sort of 30 to 35% range from 2014 on. It's now down to about 23%. That is, the refi activity is much more concentrated in Fannie and Freddie, and that's resulting in a decrease in the Ginnie Mae share. Ginnie Mae refis are up, but they're up less than Fannie and Freddie refis. Next slide, please. This shift from Ginnie Mae's to conventionals, or the greater increase in the conventional share, is clear in both gross and net issuance. So if you look at this slide, you can see that year to date, that is through June, gross issuance is up 115% over 2019. GSE issuance is up 135%, and Ginnie Mae issuance is up 76%. If you look at net issuance, again, 138% overall. GSE net issuance is up 248%. Ginnie Mae issuance is actually down very, very slightly. So there's been a shift from Ginnies to conventionals because of the very robust refi volume. That is, more of the market share is in conventionals at this point. And next slide, please. One last consequence of the refi wave is people are looking at 15-year mortgages seriously for the first time in a very long time. You can see that the share of 15-year mortgages actually peaked in 2002 at around 30%. Now the share of 15-year mortgages, which is the black line in this picture, is now about 16%, which is the highest it's been in 7 years, since 2013. In fact, since 2003, the 15-year share has never been higher than about 20%. And it reached that level in the 2011-2012 refi wave. It's now at 16%. So just, big increase in the 15-year share, as high as it's been in the last 7 years. So with that, let me turn it over to Karan Kool to talk about credit risk transfer.
Thank you, Lori. So let me take a few minutes to discuss recent trends in the GSE credit risk transfer market. As you all know, Fannie Mae and Freddie Mac have been using the credit risk transfer securities to transfer credit risk on their mortgages to capital markets investors. For background, this market is still fairly new. It was created only in 2013 and basically provides a very efficient vehicle for the GSEs to transfer mortgage credit risk away from taxpayers. However, one criticism of the CRT securities from the very beginning has been its potential vulnerability during downturns. That is, there's usually ample investor demand for these securities during good times. What that does is that it keeps prices economical for all parties and allows them to transact with each other, and in turn allows a market to function smoothly. In comparison, investors have very little or no willingness to buy these securities during downturns for reasons such as forced selling, saving cash, or avoiding risky assets more generally. And that's exactly what we saw happen in March and April of this year as the pandemic started. And that's exactly what you see in this graph. What this chart shows is the pricing for the mezzanine tranches of the CRT securities issued in 2017, 2018, and 2019. And you can see the pricing, December 2017 onwards. These prices are expressed as basis points over the 1 month LIBOR rate. That is, and as you can see, prior to the pandemic, that's before March of this year, these M tranches were consistently trading around a spread of around 200 basis points or so above the 1 month LIBOR rate. But as the crisis started in March, as you can see, the spreads widened dramatically and almost instantaneously. By late March, the 2017 M index was trading well over 1,600 basis points above the 1 month LIBOR. The 2018 and 2019 indices were also trading well in excess of where they used to be. Specifically, the 2018 M tranche was trading at 1,400 basis points above the 1 month LIBOR, and the 2019 tranche was trading at 1,200 basis points above the 1 month LIBOR. So really, really shockingly high spreads. What it means in real simple terms is that to the extent there were any investors willing to buy these securities in March, they were demanding an extraordinarily high rate of return in exchange. On the positive side, though, as April came about, we did see that spreads began to tighten rather quickly in April and then continued to drift downward in May and June. In fact, as of around mid-July, pricing on these tranches sits at around 300 basis points or so above the 1 month LIBOR. That's still higher compared to where it used to be before March, but it also shows very clearly that market economics have recovered to a substantial extent, and it has done so in a rather short period of time. Perhaps an even more, still the same slide. Thanks. So another important signal that the CRT market has recovered came in early July when we saw Freddie Mac come to the market and actually complete its first CRT issuance since March. I mentioned earlier, market dynamics have a lot to do with when the GSEs come to the market with these securities, and the GSEs tend to avoid issuance during unfavorable market conditions. It was good to see Freddie Mac come back to the market in July. And investor demand for Freddie's July offering was so strong that it actually had to double the size of the planned offering to about $1.1 billion. Now that could partly reflect pent-up demand after 3 months of no CRT issuance by either Fannie or Freddie. Let me also mention one more recent development that could have implications for the CRT market going forward. A few weeks ago, the Federal Housing Finance Agency, which is the regulator of Fannie Mae and Freddie Mac, they released a set of new proposed capital standards for the GSEs. If these standards were to be finalized as is, that would greatly reduce the GSE's incentive to engage in credit risk transfer transactions in the future. Now, it's again too early to tell how much of an impact that would be, or how much that will affect volumes, but that's just something to keep in mind as a factor that could have really serious implications for the CRT market moving future. Next slide. And I want to just take a minute or so to quickly highlight, the role the Fed has played in the agency MBS market and some of the implications. Unlike the agency MBS market, as you can see here, the Fed has been really, really aggressive in buying agency MBS over the last few months. In fact, the Fed has injected nearly $800 billion of total liquidity into this market since March. In comparison, the CRT market has recovered without any liquidity support from the Fed whatsoever. So that again speaks to the resiliency of the CRT market itself. And as you can see, from this chart, not only has Fed purchased a lot of these securities since March, their purchases also greatly exceed their activity during any similar period during the Great Recession. So that also speaks volumes to the extraordinary level of Fed support that the agency MBS market has received. I also wanted to point out that there's another really important market where the Fed has chosen not to intervene, and that's a non-agency space. This market basically is, fully private market, and it tends to facilitate lending for borrowers who are typically ineligible for federally backed mortgages, such as self-employed borrowers who may not meet the documentation standards of Fannie or Freddie or FHA loans, or those loans that have balances higher than what the government lending market allows. And in the absence of Fed support, this market is still largely shut, with originations running at levels that are a small fraction of where they used to be. So to wrap things up, the March panic, I think, was by far the most stressful event in the history of the CRT market since it was created 7 years ago. It's clear that we're not out of the woods by any means, but we can see from recent pricing trends that the market has come back to a large extent. And what that tells me is that investors, despite all the uncertainty, whether it's the pandemic or the FHFA's proposed capital rule, investor commitment to owning CRT securities remains very, very strong. So, with that, let me quickly turn it over to Amy Cruz-Gutz, who we're very excited to have with us today. Amy, thank you, and please take it away.
Amy, you're muted.
Sorry. Hello again. It's figuring out this technology with the mute here. Sorry. All right. Let's do a. Can you all put my slides up?
Yeah, are you able to access that share screen button on the bottom?
Yeah, I can do it.
Okay.
Okay, good.
Wonderful,
all right.
Wonderful.
Let's get the full thing. There we go. Awesome. Okay, thanks for having me here. It's a lot of good stuff, and I always look forward to seeing the Chartbook because it is a huge volume of quick reference that usually has the answer that I'm looking for. A couple things that I wanted to keep in mind is that it's easy, as we are so deep in the industry or deep in the data, to think about what's not right with the market. That is, if we could wave a magic wand and make things perfect. So as an example, the penalties that are in place for delivery of loans and forbearance, I think are an important function for mitigating moral hazard while keeping the option open for people who really need that help. And it's a tough situation. If I were to be czar of the world, I would probably renew the HARP program and make folks who have income disruptions eligible for refinance that they're not currently eligible for, but so far I have not been granted that power. One of the things that really surprised me about Lori's part of the presentation was how strong the non-bank share of the market has been. That if we look back to 2008, we saw all kinds of disruptions in the market, and some of this, I think, is due in part to the Fed's very fast entry into the market to stop places where there were illiquidity, and that has helped all of the market to respond better. Clearly, there are still elements that are stickier than we'd like, but so much better than what we had in 2008. I want to do a little compare and contrast here on the home mortgage side. So we go back to 2008, for actually 2009, when Obama came to the administration, and for a brief moment, there was a Democratic majority in Congress, and they managed to pass one round of fiscal stimulus with the idea they could come back and do more, but they lost the majority and couldn't do that. So it really, you know, we look at what happened so far this year, so many rounds of fiscal stimulus, and a lot of hope that something big will happen again this week along the lines of the CARES Act, renewing some of those things at strong levels. We had, you know, like now, a temporary moratorium on foreclosure, hoping to extend that as well, because this crisis clearly is not over. Contrast this to 2008, a speculative bubble. There was an element of moral deficiency on the part of borrowers who couldn't make their obligations. So forbearances were made hard to get. There was a penalty to their credit for not being able to make those payments on time, even though they entered into these plans. And contrast that to today, automatic forbearance for the asking from federally backed mortgages. Additionally, which your data also showed, there's a lot of forbearance activity happening in the non-federally backed side of the market. So a lot of lenders are stepping in and saying, well, I'd rather give them a forbearance on the hopes that I can get my money back at a later time than to force the foreclosure today, knowing how terrible that experience worked out for both lenders and borrowers. The CARES Act additionally says that borrowers will not be penalized on their credit for taking advantage of the forbearance options available to them. This applies not just to federally backed mortgages, it applies to all credit in which an accommodation is granted because of a COVID stress. It is my opinion, I've been consulting with Equifax since March, it is my opinion that several servicers of all loan types are erring on the side of generosity to consumers, not wanting to be penalized for failing to adequately report that as a COVID-related relief. So you may find you talked a little bit about forbearances, and I think these were ones probably in place before March, that about half a percentage point of the foreclosure, of the accommodations were non-COVID related. Anything that's happened kind of since the CARES Act came out, it looks more like lenders are reporting. Part of it is there's no special code for the CARES Act part of this, but they certainly seem to be erring more on the side of using natural disaster or simply using the deferral codes when they report to credit bureaus. So importantly, no hit to consumers for that. So there's a default option incentive change that happened. We have not seen house prices fall nationally. There were a few markets already on the rocks before March, but mostly homeowners are maintaining equity at levels prior to the start of this. So what's happened with the CARES Act is it removed the default incentive. Go back to 2008, we had foreclosure timelines that were extended, officially not before 300 days with the GSEs, effectively much longer. In Florida, at the worst point, it was more than 1,000 days between the due date of the last paid installment and when the foreclosure sale happened. Eviction came later. So when borrowers were offered relief through the HAMP program of a payment greater than zero for some period of time, continuing hammering on their credit, and potentially no chance of equity being positive in the foreseeable future. Borrowers have a very short, narrow window for when they want to see a return. The option became 1,000 days of free rent or go through the HAMP program. And 1,000 days of free rent for many families was a huge default incentive. So we come now, borrowers automatically get essentially a free year of rent by deferring those payments until the loan maturity. So there's a huge change in that incentive. What that's done is it's kept distressed sales out of the market. It's kept borrowers, it's supporting borrower finances during that time. They can use that money to keep other bills current. They can use that money to save up for when the forbearance ends. It has created a tremendous relief for these families. And that notwithstanding the disruptions it caused to servicers, still a very big deal for consumers. Okay, I want to talk a little bit. These are some different views. All of the rest of these slides are taken essentially from what is on Equifax's website. They're doing now bi-weekly webinars on credit trends, but weekly credit trends reports on originations and portfolio. And as well, they're also doing a little podcast with accommodations. Importantly, their originations data is not adjusted. The monthly reports when they come out are adjusted for loans that they believe are originated but not yet reported. And that it's a simple scaling up based on prior reporting timelines from lenders. This chart will change a little bit for the most recent weeks as more loans come in, but the important side of this is corroborating what the Urban Institute's Chartbook says, is that FICO scores are rising. By the way, the Equifax reports also show Vantage scores if you're interested to see how they're migrating. Importantly, in these charts, the bottom parts here with those, so there's a dark blue bar at the bottom, that represents 620 to 660 scores. So we're down to about 2% of loans in the first mortgage side that are in the below 620 band. So very small numbers of loans coming in with those. HELOCs still remain tight. Both of these have median scores in the 740 to 779 bracket. So really, really tight credit in both, but not as huge of a change as we might have anticipated. Certainly not what we saw in the Great Recession. Mortgage delinquency rates have tumbled during this time. Now, Equifax does not include accommodations, that is to say the presence of an accommodation, in their delinquency rate. So whatever it's reported at, that level of delinquency in compliance with the Fair Credit Reporting Act is what goes into these numbers. Importantly, if you've taken a forbearance, you're not going to enter before you got delinquent, you're not going to enter the 30 and then the 60 and 90 day delinquency window. So that has certainly taken off the table some of those delinquencies that might have happened in the normal course of events were it not for those forbearances. HELOCs, the delinquency rate has stayed relatively steady, even with a slight increase in loans in forbearance. Okay, credit cards, I got some questions earlier from the staff at the Urban Institute about what's happening with credit cards. Credit card balances are declining fairly rapidly. It's $90 billion since the start of the crisis. This is a combination of both borrowers who would normally be revolvers, who are not spending additional money, perhaps got a forbearance on their mortgage, or maybe they've gotten a forbearance on their rent, and they're applying that money to their credit cards. It's also transactors who are not transacting as much. If they're not taking vacations, if they're not going out to eat as much, going to theaters and so on, that money then is not getting charged in the first place. This is consistent with what Chase and other credit card servicers are reporting. Delinquencies on those as a result, of course, are also coming down. Now, got a question from Wall Street Journal. This was a month ago. It took us several weeks to talk her down from the story she intended, which was how borrowers were using their HELOCs and jacking up that balance, as well as banks cutting credit lines. Neither of those two stories is true. We're also not seeing it in bank cards. The limits are staying fairly steady. The private label cards, they're closing some of those accounts as some of the retailers behind them are also suffering. So some of those accounts, especially the not used ones, are coming down. But on HELOCs, we're seeing a generalized trend consistent with what happened before, of balances coming down on those and the numbers of accounts coming down. New HELOCs are not being issued at the same rate, as several of the largest lenders have simply stopped taking applications. So importantly, we're not seeing borrowers rely on their lines of credit. I want to talk briefly about loan accommodations. Unfortunately, with the passing of the CARES Act and these greater emphasis on accommodations, they did not give a hashtag Congress Cares new narrative code for reporting to credit bureaus. So we're relying on the possible ways they can be reported in existing Metro 2 guidelines. The CDIA, which is the Consumer Data Industry Association, has issued guidelines in conjunction with the credit bureaus. So a loan can be deferred, in forbearance, affected by a natural disaster, in a loan mod, partial payment plan, or what we call inferred, which is they don't use any of the special codes, but they set the payment due to 0 and the account has a positive balance. Now, this would also be the case for loans that, like a no payment due kind of loan would also come with that kind of reporting. Okay, so student loans, I want to bring this up. I know this is mortgage side, but I want to bring this up because this is huge. The special relief in the CARES Act said not only do all federally backed student loans, which is about 90% of student loans, get an automatic deferral of payments until through September 30th, but also if they are delinquent, they get marked as current. Nobody else gets this. Everybody else gets, if you were current when you entered, you stay current. If you were 30, 60, 90, whatever, delinquent when you entered it, you stay at that level. So what did this do? Well, we had 8% of accounts delinquent as of March. This was of the non-deferred accounts. We're down to about 50 basis points of accounts being delinquent now after the forbearance goes into place. So a huge difference in the number of accounts. So people ask, well, what's this going to do to FICO scores? What it's going to do to FICO scores is not that they deliberately take into account the presence of an accommodation, but the removal of the delinquency will help these borrowers across the board in obtaining credit during the crisis. So a massive change. This is the biggest one, I think, to hit the industry in a long time. A big change. So just a few things here. This is from Equifax's data. It tracks what the MBA is saying. I didn't have time to get the data for the home equity installment loans, but you can see here how about 9% of balances and 8.3% of first mortgages with those possible codes. So that's the last of my comments. So I'll turn it back over to Lori and the team and go from there. So
great. Well, thank you very, very much. And anyone who has questions, either email them to Cheryl or put them in the chat. We will be sending the slides and a link to the recording after the call for those of you on the line. Any questions in the chat yet? Not yet. In that case, what I'm going to do is talk a little bit about our research work. Again, questions either in the chat or to spardo@urban.org. The Urban Institute has mounted a huge effort to get data and analysis and convene thought leaders in response to the COVID-19 crisis. In the housing space broadly, there are two significant efforts happening. First is the Mortgage Markets COVID-19 Collaborative, which we're running out of the Housing Finance Policy Group. This collaborative is bringing together mortgage industry stakeholders, consumer advocates, and researchers to share data and policy ideas and develop collaborative solutions that will encourage sustainable homeownership, system stability, and equity in response to the COVID-19 crisis. You can learn more about the participants and the work we're doing on this on our landing page. Urban's president, Sarah Rosen-Wortel, is heading up an effort to stabilize the renters market through the Renters and Rental Market Crisis Working Group. This working group, which Housing Finance Policy Center researchers are also involved in, brings together advocates, industry, policymakers, and philanthropic organizations to share data and policy ideas and develop collaborative solutions that will stabilize renters and multifamily owners during the response to the COVID-19 crisis. Since April, we've hosted 2 webinars, What's Next for the Community Reinvestment Act, CRA, and Caring for Borrowers Outside the CARES Act, a closer look at privately held loans. You can watch both events on the Housing Finance Policy Center landing page. We've also published 10 research briefs in the last 3 months, half of which are COVID related. The others examine the FHFA's capital rule, the Community Reinvestment Act, allowing non-banks to become Federal Home Loan Bank members, how the crisis and disasters impact racial disparities in home ownership, and trends about the increase in home prices between 2009 and 2019, between 2000 and 2019, namely the more robust home price appreciation at the lower end of the market. We've also published 12 blogs in the last 3 months, including 3 related to the Community Reinvestment Act data and rulemaking, and 4 specifically related to COVID. All of these blogs and publications are available on our landing page. In the coming weeks, we'll be releasing additional research into the structural barriers to homeownership for communities of color, an in-depth look into housing issues in the city of Newark, New Jersey, and another analysis of the FHFA's new capital rule. We'll continue to release COVID-19 work about servicing issues, access to credit, and assistance for renters and mortgage borrowers. Finally, mark your calendars and plan to join us for our next webinar on August 6th from 3:30 to 5 on how changes in property taxes shape communities, 2 case studies. We'll be joined by Lee Ding from the Federal Reserve Bank of Philadelphia, who will analyze the effects of gentrification, as well as several gentrification relief efforts on homeowners' tax delinquencies, residential mobility, and displacement in Philadelphia. And our own research analyst, Sarah Strochak, will address the likely impact of split roll legislation in California, which proposes to tax commercial and industrial properties based on their fair market value, resulting in a different tax rate for residential properties remaining under the jurisdiction of Proposition 13. Mark Fleming, the chief economist from First American, will discuss both papers, highlighting the role of property records in the analysis. With that, let me see if there are any questions yet in the chat. What is your view, Lori, what is your view on 2021 mortgage volumes under a Biden administration versus a Trump administration? Very good question. And Amy, I don't know if you want to weigh in on this one, or if I should take it.
So yeah, I don't see any difference. It's primarily driven by interest rates. The possibility might be what, again, and this would not be the administration, but I think more what would happen in Congress. So that we might see some very big changes there, again, like a HARP program or something like that might happen if the pandemic problems are still present then. But we survived Obama, we survived Bush, we survived, right? We've had all these things in the past with various administrations. So I don't see, personally, it will be different. I don't know that it will be better or worse.
Yeah, I don't have a strong view on on how different interest rates would be under the 2 administrations. I do agree with Amy that a new that a HARP 3.0 program would be a game changer, and I too support it. I mean, it is ridiculous if you already have the credit risk on the mortgage not to allow borrowers to take advantage of lower rates. And when you look at sort of the FICO drift particularly in refi mortgages, you can see that a lot of lower FICO borrowers just aren't getting the opportunity to refinance. And certainly a HARP 3.0 program would change that and boost volumes. Otherwise, I don't see a huge difference. Another question: what's happening to DTI levels based on the updated affordability? Are people using it or taking lower payments? I think DTI is actually declining slightly, as you would expect in a lower interest rate regime. House prices are still going up. They're going up very modestly. Meanwhile, interest rates are going down dramatically, and it's resulting in lower debt to income payments for most borrowers. Any other questions? Cheryl, have you received any questions?
I have not. The 2 that were in the chat room are all I've seen. You guys were
Great.
very clear.
Well, with that, I'd like to special thanks to Amy for joining us today. Terrific presentation, and thank you very much. I learned a lot from it, and thank you all for thanks to all my colleagues in the Housing Finance Policy Center for participating in this, and thank you all for joining us. We'll see you again in 3 months for the same thing, and hope to see you on August 6th for our webinar. Take care. And
Bye-bye.